So we do have the management of HCLTech, who's joining us now, so would invite you to listen in as well. HCLTech is down in trade on the back of a disappointing set of Q4 numbers. Their revenues came in line with street estimates, but it's the margins that have contracted. The company's growth outlook of 3 to 5% for FY25 has also come in below expectations. To discuss more on the Q4 performance, my colleague Reema caught up with the management, began by asking him about FY25 guidance and how they'll manage to meet their growth targets. Listen in.
What we have assumed is the external environment and the amount of discretionary runoff that happened in FY24, we've assumed exactly the same numbers for this year. 3 to 5 is our guidance. And if you look at the every year, there are a lot that can happen during the year. And I think more important than the guidance, I think what's very relevant, Reema, is in FY23, we had the highest growth in services. We had the growth leadership in the industry. 24, we maintained the growth leadership. And I'm pretty confident that we will maintain the growth leadership in a handsome way this year as well. This is based on what we're seeing in the market, based on the deals that we're participating, the pipeline that we have. However, it's important to remain cognizant of the fact that there is some discretionary runoff that happened all through FY24, and we made the same assumption, and it's a mathematical calculation which leads us to 3 to 5% guidance.
Okay. You've also said that there's a 2% negative impact in Q1, or Q1 revenues will be down 2% because of one large project which is getting offshored now. And in Q2, there will be an 80 basis points impact due to the State Street JV exit. So will Q2 also have a negative growth, and will the company bounce back to growth only in Q3 and Q4?
Actually, Reema, there's just a lot of optics, right? I mean, if you take Q1 at a 2% decline, HCLTech will still be the fastest growing company year on year. It'll be probably upwards of 5.6, 5.7%, which is even higher than our guided range. And even if I assume a 1% growth, we will again be a pretty handsome growth, which exceeds our guided range. So actually, our H1, technically from a year-on-year perspective, will be a strong first half. So I think HCLTech cannot be compared on a QOQ because 3 out of the 4 quarters, there is seasonality in the business. Either in December, we have a peak, and then there is a softness in JFM quarter in the software business. And Q1 is soft because of a year-on-year contract productivity that kicks in. So the right way to look at our numbers is year-on-year. And maybe if you really needed to compare, then that should be the comparison.
Okay, but just in Q2, will it be growth or will it be a decline in your top line, CVK?
Right. See, we've done $2.3 billion of booking this quarter, a bulk of which will translate into revenue in Q2. And we remain confident of growth in Q2 and the subsequent quarters, which should nicely help us deliver the market leadership on the growth.
Prateek, your margin guidance stands at 18 to 19%. Can you explain the math behind that? And your aspiration is to grow margins to 19 to 20%. When do you get to that?
Yeah, Reema, thanks. I think, last 2 years, if you see FY23 as well as FY24, we have given the guidance of 18 to 19%. And we've delivered exactly the same number, 18.2% in both those years. So given the environment that we are currently going through, I think that's the right range for this period. The aspirational range of 19 to 20% that we have talked about is a little pushed out right now. But our efforts are always to sort of get back to that pre-COVID kind of a range that we talked about. So right now, I wouldn't take a sort of punt on when we will be able to come to that. But for now, for this year, which has just started, we are sticking to 18 to 19%.
Okay. And just, Prateek, if you could weigh in on the deal wins and the pipeline. Can you give us the mix between large, small, mid-size? Because we had emphasis last week, and they spoke about how short burst deals of a smaller size between $0 to $10 million are picking up, and that's the highest that they've seen in the last many quarters. So explain the deal pipeline to us.
Yeah, so like I think CVK referred to it already, I'll probably expand a little bit on that. See, the thing is, in any quarter, in any fiscal year as well, there is a substantial part that is comprised of the small deals, 0 to 10 million, like you mentioned. And not only that, but during the year, there are several deals which come into the pipeline, get booked, and then the revenue gets delivered as well. So that is the nature of our business. I'm sure that's what Emphasis talked about as well. And we remain focused on all sizes of deals, because at the end of the day, we have to really, the momentum and the velocity of those deals really determines our growth. As of now, going into the new year, we have not assumed any optimism that the environment will get better. We have assumed that it will remain the same as what it has been for the last 4 quarters. And with that, and given all the calculations and estimates and assumptions, we came to 3 to 5%. It is a little soft. I mean, most people were expecting 4 to 6 or something like that. It is about 1 percentage point lower than that. It's not a mile off.
Okay, fair enough. CVK also talked to us about the annual productivity benefits that you're passing on to the clients. Is that more than normal this time? And two, in your guidance, if you could talk about which geographies, which verticals will do well for you and which might be a drag.
So first, maybe let me take the geographies and verticals. I mean, if you see our financial services delivered 12% growth when across the industry, most people declined. I think a lot of this is to do with the big bets that we took, whether it is insurance, wealth management, or the hybrid cloud adoption in some of the large financial services firms. I think that momentum will continue, but of course, we are coming off a very high base. So to that extent, the financial services will be modest. But tech is going to rebound. I mean, we already have enough pipeline. We think tech will do well. Telecom will continue to do well. In addition to the large deal, we have a number of programs in telecom service provider segment that's going to help us. Retail CPG will do well, and manufacturing and life sciences, I think it'll maybe it will do well in the second half. That's really the kind of vertical split. But if you take the geography, US continues to be a very strong geography for us, even in FY24, when there was a lot of stress in the environment, we grew 6.8% in the US. Europe will be a little soft, and that's broadly how I see the environment going forward.
And the annual productivity benefits that you pass on to the clients, is it more than normal this time?
Actually, it's in some cases it's a little more, because the automation expectation is generally higher. While most of this, what we're talking about, are productivity which is already in the contract, and where we have assumed certain level of automation will come in as we continue to execute some of the run the business kind of programs. When there is a new deal that's renewal, in fact, even last quarter we did more than $2.5 billion of renewals. And in the renewals, of course, there is a lot of emphasis on factoring in the productivity of GenAI. But again, when we say productivity of GenAI, customers are also looking at greater volume getting delivered for same. In fact, I talked about doing more with less. That's really what the theme is. But doing more, while it is some form of a commitment from the customers, but it will only happen over a period of time. I mean, it does not come on day one. So every renewal, we end up getting commitments for significant additional business. it's more than offsets the productivity lever that we pass on to the clients.
Okay, that's the word coming in from HCLTech. Let's do